Ladies and gentlemen, thank you for joining me again. This is Christopher Aaron coming to you for a midweek update on the price of gold and silver and related analysis on the 25th of November. And I just wanted to say quickly, I do have a new article that is up on my partner website, Gold Eagle, and I will have that link below. This article covers some of the emerging trends that I see developing in the gold mining sector. We've had some interest in this sector over the last couple of videos, so I wanted to provide this article for you. That is available for free. And a happy Thanksgiving to anyone who is celebrating that holiday here in the US or in Canada, I believe, perhaps elsewhere. At any rate, the markets are slow for this week. And for the next 2 days, on Thursday and Friday, the markets are closed here in certain parts of the world. So we will not have a weekend update this weekend, barring an unforeseen circumstance. Every once in a while, you will have a strong move over a holiday weekend like this. And if that happens, I will bring a flash update with a quick video. Otherwise, this analysis will cover us through the following midweek update next Wednesday. So I did want to take this time to look at something that has been discussed quite often recently, and I had a recommendation from a viewer to cover this. That is the action in the US dollar. And we have a lot of related action between the dollar and the price of gold. So if you're a precious metal investor, it's something that is worthwhile to pay attention to. And here we are looking at the price of the US dollar related to other currencies over the last 35 years. I believe when you're looking at a form of analysis like this for the first time, you have to start with the big picture overview before you can get into more of the short-term predictions. So here is that 35-year chart, again, measuring the value of the US dollar versus the euro, the Japanese yen, the Swiss franc, the Australian dollar, the Canadian dollar, and a few other smaller currencies mixed in there. So what is the number one feature here that we're looking at? Obviously, it's this long-term downtrend shown here in magenta. From the high in 1985 all the way down to this recent low in 2011, shown here by this sloping long-term wedge pattern. Now, to bring your attention to a few other components of this chart, here in black, we are simply looking at the horizontal support and resistance lines as they appear on the chart. So we let the chart show us what is actually happening in the markets. So these are the important pivot points shown in black. These light gray lines here are the Fibonacci retracement lines for the entire move down in the value of the dollar versus other currencies. So the starting point here at 165 roughly on the index to the low of about 72 on the index, these lines represent those Fibonacci retracement levels: 38.2%, 50%, and 61.8%. These levels are often hit as markets make retracements to their primary trend. Here shown in blue is the primary trend that we find ourselves in today. So what has happened here with the US dollar is that we've had a generational decline. And this magenta downtrend line here was broken just last year in 2014. When a trend line is broken, it necessitates a new trend developing. So that is shown here by our primary trend primary being trends of anywhere from a year to roughly 10 years, as compared to our long-term trend lines, which are usually multi-decade trend lines. So if you look here closely, you see that break in red shown by this circle, and we find ourselves today at roughly 100 on the index. Now, what is to happen to the value of the dollar going forward? That is, of course, the important question. We have a few potential targets. Number one, yes, the long-term downtrend appears to have been broken. And we have this new primary uptrend in the dollar that has formed. So one target that comes into play here is to say that from 100, roughly, where we find ourselves today, I think it's a tiny bit lower than 100 as this video is being recorded. From this level right here, we are looking at this upper trend line as a likely target. So that would put us right around 102 on the index, 2% higher than we are today. Now you also have this 38.2% Fibonacci retracement of the entire 30-year downtrend that comes in here right around 106, 106.8. So I've highlighted this green circle here to show if the US dollar fails to move above 100, this will represent a double top. But if it exceeds 100, we will be looking for a move to somewhere in this green circle here over the next several months, before I would expect a bit of a retreat back down into this primary uptrend. Now the dollar could fall all the way back down to this magenta broken trend line here, which I have not changed to the turquoise color, but I will on the next slide. It could fall all the way back here to this apex point and still be within this primary uptrend. That is my analysis on the value of the dollar as compared to other currencies. So there is an uptrend going on in the dollar right now. Now, what does this mean for the price of gold? And is it the end of the gold bull market because the dollar is trending higher now? My answer is no. Let's take a look here. Here's that same chart that we just had up, the dollar over 35 years. And below it, the price of gold over the same 35 years. Now here's the point that I want to make to you. So we have the dollar, follow my mouse, right here at the 100 level at the end of 2015. Look at some other times that the dollar has hit this 100 level. Back here in 2003, back in 2000, in 1998, in 1989, and in 1980. So we can say that over the course of 35 years, the dollar has wildly gyrated, but has stayed at roughly the 100 level on this chart. Now, what has happened to gold in this time frame is from the previous peak of 850, gold came all the way back down to 250 and then has spiked to 1900 before we find ourselves here at still above $1,000 per ounce. So you can see very clearly that the price of gold is not directly related to the value of the US dollar. The US dollar basically at the same point that it was 35 years ago. And gold still well above where it was 35 years ago. And furthermore, if you are to compare some of the other data points on here, for example, 90 on the index, shown in this black line, you will see that the data point for 90 corresponds to roughly 1,000. This data point for 90 corresponds to roughly 900. This data point for 90 corresponds to roughly 400. So guys, when you hear people in the mainstream press or on other financial channels telling you that because the US dollar is rising, therefore gold is going to fall, show them this video or copy these charts and show these charts to them. This shows here in no uncertain terms that over the long run, the US dollar does not determine the price of gold. Now, over the short run and the intermediate run, yes, there can be correlations, absolutely. Certain times the correlation is stronger than others. Certain times, as we showed in the last presentation, gold and the dollar move together in the same direction. They'll both move up or they will both move down. So really the takeaway point here, guys, is to show you the proof that over the long run, it's not so much that gold and the dollar move opposite one another. Really what's happening here is the dollar in this top chart is being compared to other fiat currencies. So think about the analogy of different ships that are sinking, and you're hopping from one sinking ship to another, and you're saying, well, this is better than being on the fastest sinking ship. Well, yes, it is. In the case of the dollar rising here over the last few years. However, they are all falling relative to gold. And I could bring up many charts of gold in foreign currencies, and I'll probably do that on the next video, but many charts of gold in foreign currencies to show that all currencies are losing value relative to gold over the long run. Of course, we have a shorter run concern here because we're trying to make money over the course of the next several years. That's why we look at the short-term action as well. Gold, very steady here over the last few days. Now, anytime you see here on the left this axis that shows $2 increments, 1068, 1070, 1072, just know that this is basically just noise. There's very little trading going on here when you see these $2 increments on the y-axis. So gold here closing at 1072 today, the day before Thanksgiving. Pretty much in the mid-range for the last few days. How does this look on our 6-month chart? We are basically still where we were before the last video, which is right here below the July low, kind of hovering in that region. Now I'm impressed that gold hasn't broken down sharply. Oftentimes there will be a sharp break as soon as a low is taken out, a previous low. We haven't seen that yet, so we are watching to see, does this low represent a nominal new low that doesn't really materialize into something? We don't have that data yet. We're watching for that. Just looking again at the gold miners, we've been looking at that over the last couple presentations, still holding here above the July low. So it is a clue. It is leading us in the right direction, saying that perhaps even if gold moves a bit lower, this may be the final move lower in gold. Looking at that gold chart from the 7-year time frame puts us in better perspective. Here we are in this lessening downtrend zone here shown in blue, having perfectly hit our 50% bull market Fibonacci retracement and still above the 1980 former all-time high. Comparing that to the action in the gold miners for the last 7 years, and you can see the significant weakness that has come into the gold mining sector as these companies have really been unable to make significant profits due to a lot of factors, a lot of rising input costs, poor management, excessive dilution of shares in a lot of the major companies, a lot of debt that was taken on, when prices were higher. So there's a lot of fundamental reasons why these gold mining companies have fallen so severely. The basic crux of my article on Gold Eagle, if you want to check that out, is that when these gold mining companies are revalued higher as the price of gold and silver stop falling and rebounding over the next several years, that these gold mining companies will represent an immense opportunity for profit given proper diversification, given proper selection and research, and proper risk tolerance. So these are definitely companies that can go bankrupt, and everyone needs to be aware of that, whereas gold, the metal, can never go bankrupt. On the flip side, if gold goes back to 1900 an ounce, some of these companies may go up 500 or 1,000% in that time period. So there is the opportunity for successful speculation for individuals that have that higher risk tolerance. And I am certainly not recommending that for everyone, nor do I recommend that you put the bulk of your money into the mining companies. But really, it's an opportunity to have a bit of an outperformance if you are someone that has that discretionary capability. Enough about that. Here's where we look at the downtrend lines coming in the gold miners. And we will know when these two, the royal blue and these long-term downtrend lines here, are broken, we will know that the downtrend is over for the gold miners. Right now, we're still kind of bumping along the bottom despite that outperformance that we're seeing here over the last 6 months in the previous slides. So we're watching for this to see, as this bottoms, does this rebound strongly enough to break these downtrend lines? I'll let you know over the next couple weeks. Looking at silver, again, the same thing. Very light action here in the silver market. Interestingly, we broke below 14, which was the previous low. And then it's almost like the market just didn't care. It just rose back after that, closing today above 14 again. So this is exactly the kind of lessening of the downtrend that we would expect to see as these metals are looking for a bottom. You'll have these breaks below a previous level. Let's look at the next slide. You'll have a little minor break here below the previous level, just by a small fraction of a percent perhaps, and then sort of a disregard of that. Silver Wheaton, tuning in to that again, the silver side of the mining complex, again showing that clue to a potential bottom here in the price of silver to come, even if there's a nominal new low. Silver Wheaton showing that it's expecting some solidity at least until perhaps this line breaks. Let's hope not, but if that line were to break, that would give us a sense that, okay, there's one more downtrend to come in silver. As of now, we're still seeing the strength here. Here's what we expect for silver over the course of the next year. At some point, this wedge formation will break out. Very strong chance that this breaks out to the upside, given the severity of the declines and the lessening of the declines over the last few years. Now, looking here at the bottom section of this chart, I always have at the bottom of every chart the commodity in question related to an average. So in this case, we're looking at silver compared to the CRB index, an average of commodities. And we can see that as silver has been moving down, silver has also been moving down relative to other commodities. But look right here. We've had our first tentative break above this long-term relative strength line right here in October, and that is coming back down a little bit. And this is exactly what we would expect as a bottom is attempting to form here in silver. We would expect to see silver stop underperforming and start to perhaps moderately outperform other commodities, such as oil or copper or natural gas. So again, it's not this moment. The bottom may not be in yet, but we're getting this confluence of clues here that the bottom is developing in the intermediate time frame. And just looking at that silver wheaten chart from the same 5-year time frame, we can see it has moved significantly lower as well. But just right here, we're seeing that strength over the last couple months. And we are also looking at the relative performance here of silver wheaten compared to a mining company index, the HUI index, which shows that this leader in the silver space has been outperforming most other miners, even as the price has been going lower. So again, just another clue. In sum, gold where it was at the last presentation, still looking for this bottom between 850 and 1033. We are talking a little bit more about some of the mining companies, and we are mentioning that they have enhanced reward and risk over the next 10 years. I would never want anyone to think that they can absolutely make more in the mining companies that they can in the precious metals themselves. However, sometimes you can, and sometimes that outperformance can be phenomenal. That's actually what led me to this point, is I happened to be investing in silver wheaten during the last bear market when it was around $2.50 a share. And that went up over 1,000% to roughly $40 a share over a couple years. And so I began studying this stock and studying the relationship between these companies and the price of the metal, looking for that final low in silver between 12 and 14. Guys, thank you so much for joining me. Have a very happy Thanksgiving, and I'll see everyone this time next week.